At the end of this year, U.S. government debt stands above $34 trillion. That number alone is not the story. The story is what isn't happening. Markets aren't panicking. Politicians aren't proposing real cuts. Institutions aren't preparing for repayment. That silence is the signal, higher than during World War II, higher than during the financial crisis, higher than the pandemic. And yet, the system behaves as if this is normal. Only one other major economy has lived inside permanent debt at this scale: Japan. Debt above 250% of GDP, decades of stagnation, permanent monetary intervention. The United States is now moving down the same path, but with a global reserve currency and the entire financial system anchored to it. This is the part most people miss. Debt is no longer treated as a temporary failure. It is treated as a permanent operating condition. Once that shift happens, repayment is no longer the goal. Management is. And when a system stops trying to solve a problem, it starts reorganizing itself around it. That is what is happening now. Debt is not a bill waiting to be paid. It is the asset the system runs on. In the United States, federal debt now exceeds 120% of GDP. That level was once considered an emergency. It is now infrastructure. In 2024, interest payments alone approached $1 trillion per year, more than national defense, more than Medicare. But here is what matters more. Those payments do not disappear. They flow. Banks hold treasuries as collateral. Funds rely on them for stable yield. Central banks use them as reserves. Debt is not dead weight. It is income for someone. This is why the system does not rush to reduce it. New debt is issued to service old debt. Old debt is rolled to avoid default. Nothing is retired because retirement would remove liquidity the system depends on. This is the inversion. The economy is no longer borrowing to grow. It is growing to sustain the debt structure that already exists. Once debt becomes the foundation of financial stability, reducing it stops being a policy option. It becomes a threat. That is why paying it down is no longer debated seriously. Not because it is unpopular, because the system cannot survive the attempt. This is not the first time a system has relied on debt to delay reality. In the 1920s, credit expanded faster than income. Margin debt fueled growth. Asset prices rose. The economy looked strong. It held until it didn't. When credit tightened, the system collapsed under its own leverage. In the 1970s, debt expanded again, this time through government spending and monetary accommodation. Growth slowed. Inflation absorbed the imbalance. Living standards fell quietly while the numbers adjusted upward. The system survived by devaluing purchasing power instead of defaulting. In 2008, the same structure returned in a more complex form. Debt was no longer just public. It was embedded in banks, housing, derivatives, and global balance sheets. When it broke, it was not written off. It was transferred. Private losses became public obligations. Balance sheets were repaired by expanding the sovereign one. The debt did not disappear. It moved. Each cycle followed the same logic. Debt grows faster than the real economy. Stress builds. A correction threatens. The response is not resolution. It is expansion. Each intervention raises the floor and lifts the ceiling. The next cycle starts at a higher level of dependency. What was once extraordinary becomes normal. This is the part most people miss. The system does not learn restraint. It learns tolerance. And tolerance for debt always increases until it becomes the only way the system can function. What looks like stability is often just delayed recognition. What looks like control is usually just postponement. History doesn't show debt being solved. It shows it being rolled forward, crisis after crisis, until the structure depends on it completely. That is the stage we are in now. There is a point where debt stops being a burden and becomes a requirement. Before that point, a system can choose. It can slow borrowing. It can absorb pain. It can rebalance. After that point, every option breaks something vital. The United States crossed that line quietly. When interest rates rise, debt service rises with them. When debt service rises, deficits widen. When deficits widen, more debt must be issued. This is the loop. At current levels, even modest attempts to reduce borrowing trigger immediate stress. Financial conditions tighten, markets react, growth slows, tax revenues fall. The effort to fix the problem makes the problem worse. This is why serious austerity never appears on the table. Cut spending aggressively and the economy contracts. Raise taxes sharply and capital retreats. Allow defaults and the financial system freezes. None of these are theoretical risks. They are mechanical outcomes. The system has become too large, too leveraged, and too interconnected to absorb correction at scale. Debt is no longer supporting growth. Growth is supporting debt. That inversion matters. It means the economy is no longer optimizing for productivity or resilience. It is optimizing for continuity. As long as the system continues to roll its obligations forward, it functions. The moment it tries to step backward, it destabilizes. This is the trap. Not because policymakers lack discipline, but because the structure no longer allows it. Once a system reaches this stage, choice disappears. Management replaces control. Delay replaces resolution. That is what the point of no return looks like. Every proposed solution assumes the system still has room to maneuver. It doesn't. Start with spending cuts. At this scale, meaningful reductions hit growth immediately. Lower growth shrinks tax revenue. Shrinking revenue widens deficits. The math reverses the intent. Raising taxes follows the same pattern. Higher taxes slow investment and consumption. Capital shifts. Economic activity contracts. The base erodes before the debt does. Growth is the most popular answer. Outgrow the debt. But growth now requires debt expansion to occur first. Stimulus precedes output. Borrowing precedes investment. The causality has flipped. Inflation is treated as the quiet escape. Let prices rise. Let the debt shrink in real terms. But inflation does not erase obligations. It shifts them. Purchasing power falls. Wages lag. Living standards absorb the adjustment. Default is never mentioned publicly, but it is always implied. Yet a system built on treasuries cannot selectively default without collapsing the assets that hold it together. Pensions, banks, reserves. Each solution breaks something the system depends on to survive. That is why none are chosen. This is not political cowardice. It is structural constraint. The system is not searching for an exit. It is searching for stability. And stability, at this stage, means rolling forward what cannot be resolved. Not because it works, but because every alternative fails faster. Permanent debt does not benefit everyone. It benefits specific structures. Debt is an asset. For someone, every liability sits on the other side as income. U.S. government debt is held by institutions that require stability, not repayment. Banks use treasuries as collateral. Funds use them as safe yield. Central banks use them as reserves. The interest flows continuously. As debt expands, so does the stream of payments tied to it. That stream is predictable, contractual, protected. This is why rising debt does not trigger panic at the top of the system. It reinforces it. The larger the stock of debt, the more central it becomes to financial plumbing. Liquidity depends on it. Pricing depends on it. Balance sheets depend on it. This creates a quiet transfer mechanism. Tax revenue services interest. Interest services asset holders. Asset holders gain stability while purchasing power below them erodes. No single actor designed this outcome. It emerged from incentives aligning over decades. Debt concentrates influence because it concentrates dependency. The more the system relies on rolling obligations forward, the more power accrues to those positioned closest to issuance, distribution, and settlement. This is why debt is never framed as a wealth issue. It is framed as a necessity. Because for the institutions that benefit from it, permanence is not a flaw. It is the feature. The system does not reward restraint at this stage. It rewards proximity. And proximity to debt is where the leverage now sits. At this stage, delay is not a failure of leadership. It is the only remaining strategy. Every institution involved is operating on a shorter horizon than the debt itself. Political terms last years. Market cycles last months. Debt obligations last decades. No actor is rewarded for solving a problem that detonates on impact. They are rewarded for preventing collapse on their watch. Cut too fast and unemployment spikes. Markets fall. Pensions weaken. The financial system seizes. Move too slowly and the numbers grow. But growth is quieter than shock. It can be managed, explained, normalized. This creates a predictable behavior. Problems are rolled forward. Deadlines are extended. Ceilings are lifted. Temporary measures become permanent frameworks. Each delay increases dependency. Each intervention raises the cost of reversal. But it also preserves continuity. From the system's perspective, tomorrow's instability is preferable to today's crisis. Delay keeps confidence intact. Confidence keeps the structure standing. This is why warnings repeat every year without resolution. Why commissions publish reports without action. Why emergency tools quietly become baseline policy. The system is not ignoring the problem. It is choosing the least destructive option available. And at this stage, that option is time. Not time to fix the debt. Time to live with it. Because once the structure depends on constant expansion to remain stable, ending that expansion becomes more dangerous than continuing it. Delay is no longer avoidance. It is policy. And policy now exists for one reason only: to keep the system functioning one cycle longer than the last. This is not a collapse waiting to happen. It is a system settling into balance. Debt is no longer an emergency. It is the foundation. The economy continues to grow, markets continue to function, institutions continue to operate, and that is exactly why this is hard to accept. Nothing is visibly breaking. Nothing is being reset. There is no dramatic moment where the system admits failure. Debt is rolled, not repaid. Interest is serviced, not questioned. Stability is preserved through expansion, not correction. From the inside, this looks like control. From the outside, it looks like drift. Most people will argue this is fine, that it can continue indefinitely, that something will eventually change. History suggests otherwise. Systems that reach this stage do not reverse. They adapt around their constraints and lock them in. The debt does not disappear. It does not explode. It becomes permanent, not as a flaw, as equilibrium. And once a system reaches equilibrium, it stops asking how to fix itself. It only asks how to continue. The uncomfortable question is not what happens next. It is who benefits from that continuation, and who is expected to absorb the cost quietly without ever being asked.